Let me tell you something straight, because I don't believe in wasting time dressing up the truth. Rule number 1, if you want to catch the big moves in the market, is this: you've got to learn to sit tight when the market is proving you right. That sounds simple, doesn't it? But it's the hardest damn thing for a trader to do. Any fool can make an entry. A halfwit can take a flyer in a stock. But how many have the patience to ride a move once it begins to unfold? That's where the money is made. And that's where most traders, even the smart ones, lose their fortune. They can't help themselves. They jump in and out. They snatch at nickels while the dollars are running away. Tell me, haven't you felt that itch to grab a quick profit before it slips away? Haven't you cut a winner short, only to watch it climb higher without you? I learned that lesson the hard way, many times over. You see, I didn't start out as a wise man. I started out as a boy chalking prices on a blackboard in a bucket shop, staring at numbers all day until they began to speak to me. I learned the tape long before I ever learned the market. Back then, when I made a little stake, I thought the trick was to take my profit quick before the market could turn on me. I was proud to grab a few hundred here, 1,000 there. But the big moves, the real killings, those came only when I had the sense to hold on. Do you understand what I mean? It's not enough to be right in your judgment. You've got to be right and then have the courage to sit still. Most people can't do it. The human brain isn't wired for it. The market goes a little in your favor, and greed whispers, "Take it now, don't let it slip." The market hesitates against you, and fear yells, "Get out before you lose it all." And so they jump in and out, like a jittery prizefighter dancing around the ring, wearing themselves down while the market, calm and steady, goes about its business. Now, tell me, do you think you can beat a force like the market by jumping around nervously? Or is it better to let the market tip its hand, and then stay with it until the move is over? I remember one trade that burned this truth into me. I had taken a position, the stock began to move my way, and I got nervous. I thought, I'll be smart. I'll take my profit, and then I'll buy it back lower. Well, I sold, and the stock never looked back. It went on climbing without me, and there I was, standing on the sidelines, watching my chance at a fortune vanish because I couldn't sit still. Do you know how that feels? To be right, but to make nothing from being right. It's worse than being wrong. At least if you're wrong, you can blame your judgment. But to be right and still lose out, that's pure torment. So, rule number 1 is this: you must recognize when you are sitting in the presence of a big move, and then you must have the iron nerve to ride it out. But here's the catch: how do you know when it's a big move? That's what every trader wants to know. Well, I'll tell you what I learned. The market talks. Not in words, but in behavior. When you see a stock break out of a range with real force, when it moves on volume and doesn't look back, that's not a small fry move. That's the start of something bigger. The public doesn't move markets like that. Professionals don't risk money like that on a whim. When you see strength that doesn't quit, that's your clue. Now, don't you think it makes sense to ride with that kind of strength instead of trying to scalp it for pennies? The trouble is, most traders don't trust themselves enough to do it. They're too eager to trade often, because trading feels like action, and action feels like making money. But the truth is, the big money isn't in the buying or the selling. It's in the waiting. That's the part nobody likes to hear. Waiting sounds like doing nothing, and people hate to do nothing. But in the market, doing nothing at the right time is the most profitable thing you can do. You ever notice how hard it is to just sit and hold when a stock is moving in your favor? That's when the temptation is strongest to meddle, to take profits, to outsmart yourself. Let me tell you, I've made millions in my life, and I've lost millions too. But the millions I made weren't because I was right all the time. They came from those rare occasions when I caught a real move and had the courage to hold on to it. When Union Pacific started its great advance, I was there. I bought it and held it. My friends told me I was crazy not to take my profit. They told me it couldn't go much higher, but I held it because the market was telling me otherwise. And that one move made me more money than 20 little trades put together. Doesn't that tell you something about where the real profits lie? Now, I don't mean to tell you that you should buy and hold forever like an investor. That's not my game. My business is speculation, not investment. The difference is this: an investor hopes the stock will pay him forever. A speculator rides the move while it lasts, and then he gets out when the move is over. Do you see the difference? The rule is not to marry a stock, but to stay with it as long as it's acting right. And when it's done, you get out without sentiment. That's how you catch the big swing. Of course, knowing when the move is over, that's another art entirely. But right now, I want you to think about this. How many times in your own trading life have you cut a winner short because you couldn't sit tight? How many fortunes have slipped through your fingers because you grabbed at crumbs instead of waiting for the cake? That's the tragedy of most traders. They get the direction right, but they sabotage themselves in the execution. Isn't that true for you too? The first time I made big money, it was because I finally listened to my own rule. I stopped fussing, I stopped trying to be clever, and I just held on. The stock kept climbing and I kept holding. Every day I wanted to snatch my profit. Every day I fought the urge, and in the end, the profit was 10 times what I would have taken if I'd listened to my nerves. 10 times! Think about that for a moment. Imagine the difference in your own account if you'd held your winners 10 times longer. Wouldn't that change everything? But it's not just about patience, it's about discipline. Discipline to follow your rule when your emotions scream otherwise. The market is a battle of nerves, and the weak are always shaken out. If you can't hold your seat when the market is going your way, then you don't deserve the big move. That's the truth. Harsh, maybe, but true. Do you think the market rewards the timid? Or do you think it pays the one who can wait with iron patience while the crowd runs in and out like frightened sheep? And let me warn you of this: don't mistake a little wiggle for the end of the move. Big moves don't go in straight lines. They jiggle, they shake, they test you. The purpose of those shakes is to wear you out, to make you doubt, to make you quit your position before the real move has even begun. If you can learn to recognize that, you'll save yourself from being tricked out of your profits. How many times have you sold on a little reaction, only to see the stock resume its march higher the very next day? Haven't you cursed yourself for being too quick? That's exactly what the market wants you to do. So when I say rule number 1 is to sit tight, I don't mean sit tight foolishly. I mean sit tight intelligently. Sit tight when the move is real, when the market shows you strength. Sit tight when the tape proves your judgment correct. That's when the fortunes are made. But if you can't tell a real move from a false one, then you'll never have the courage to hold. Isn't that what makes this game so devilishly hard? Market reactions are tests designed to shake you out. That's the truth of it, and if you've ever traded with real money on the line, you know exactly what I mean. You sit there watching a stock that has been climbing, strong as an ox, and suddenly it dips. Not a collapse, not a breakdown, just a little slip. Maybe it drops a point, maybe 2. Your pulse quickens, your stomach knots, and fear whispers in your ear, "Get out while you still can." That whisper is louder than all the logic in the world, and most traders obey it. They sell, glad to save their small profit. Then what happens? The stock turns right back around and resumes its climb, stronger than ever, leaving the poor trader stranded on the curb, watching the parade march on without him. Hasn't that happened to you? That's why I tell you, market reactions are not accidents. They're part of the very nature of a big move. Nothing in the market goes in a straight line. Think of the ocean. A wave surges forward, but it doesn't glide like a sheet of glass. It swells, it curls, it breaks, and then it surges again. The stock market is no different. A strong advance will always be punctuated by pauses, by setbacks, by those little reactions that make you question your own judgment. And here's the kicker: those reactions are not only natural, they're necessary. They keep the move healthy. They clear out the weak hands. They give the professionals more stock to accumulate. Doesn't that make sense? The market has a cruel way of testing your patience. It knows where your breaking point is. It knows most people will jump out at the first sign of trouble. And it uses those reactions like a sieve, shaking loose all but the most determined traders. If you're too quick to flinch, you'll be shaken out every time. And what's worse, you'll get into the habit of being shaken out. You'll start to expect it, and you'll never let yourself ride the big swing. Tell me, what's the point of being right if you can't hold your position long enough to profit from it? I've watched reactions take fortunes out of weak hands and deliver them straight to the strong. That's the real transfer of wealth in speculation. You see, a big operator doesn't mind those dips. He welcomes them. While the public panics, he quietly buys more. He knows the move isn't over. He knows the story is still unfolding. And when the crowd has been flushed out, the stock is lighter, freer to run higher, and he's sitting with more shares than before. Meanwhile, the nervous trader is sitting with regret. Haven't you ever wondered why stocks always seem to run hardest after you've sold? That's not coincidence. That's the market's way of punishing impatience. I learned this lesson back in the days when I played the bucket shops. The tape would run in my favor, the stock would climb, and then, all of a sudden, it would back off. Not much, just a point or two, enough to rattle me, and I'd sell, thinking I was smart to protect my winnings. But almost without fail, the very next move was upward again. I began to notice a pattern. The market was shaking me out before resuming its run. And the more I watched, the more I realized it wasn't just me. It was everyone. That's how the market works. It lures you in, it scares you out, and then it makes its real move. Have you felt that same trick played on you? The hardest thing in speculation is to distinguish between a normal reaction and the end of the move. That's what separates the winners from the losers. Because anyone can buy when things look rosy. Anyone can jump on when the stock is charging ahead. But can you sit through the storm? Can you hold steady when the stock takes a dip, when every instinct in your body screams to bail out? Most can't. They think every shake means disaster. They mistake a healthy pause for a final collapse. And so they sell, again and again, right before the real profits roll in. Now, don't misunderstand me. I'm not telling you to ignore every reaction and hold blindly. That would be suicide. The market does change direction, and sometimes a reaction is the start of a reversal. But more often than not, in a genuine bull move, those dips are just part of the climb. They're meant to test you. They're meant to make you prove you deserve the profits by holding on. And you'll only know the difference if you learn to read the character of the move. Is the reaction violent and final, breaking past real support, or is it a modest pause that never touches the core of the trend? That's the kind of judgment you must cultivate. Don't you see how critical that distinction is? Let me give you an example. In one of the great bull markets I traded, I took a heavy position in a stock that had just broken out. It ran beautifully for days. Then, without warning, it dropped 2 points. The newspapers screamed about bad news, the crowd was jittery, and many sold in a rush. I nearly joined them. I paced the floor, hands itching to give the order. But the tape didn't show panic, not real panic. It showed orderly selling, just enough to relieve the pressure. Something in me said, sit tight. So I did. Within days the stock not only recovered but doubled its prior advance. If I'd sold on that reaction, I'd have walked away with crumbs while the feast was just being served. Doesn't that sound like the difference between ordinary trading and real speculation? These reactions are traps for the inexperienced. They lure you with the promise of safety. They whisper that you can sell now and buy back lower. But more often than not, the stock never gives you that second chance. You sell, it rallies, and you're left out. Or worse, you chase it higher, only to buy back in at a worse price than you sold. The market loves to play that game with you. It teases you with the illusion of control. But the truth is, you can't outsmart it by ducking in and out. The only way to win is to recognize the nature of the move and hold on through the storms. I always say that money is made in the sitting. But it's more than sitting, it's sitting through the reactions. That's where the battle is fought. That's where nerves are tested, Because anyone can sit when the stock goes straight up. That's easy. The real test is when it drops a little. Do you have the courage to sit still then? That's the crucible. That's the point where the market decides who gets to keep their profits and who forfeits them. And the ones who flinch lose every time. Tell me honestly, how many times have you flinched and regretted it? The market doesn't hand out easy money. It makes you earn it by enduring discomfort. Those reactions are like toll gates on the road to profit. If you can pay the toll, meaning you can stomach the dip, without panic you're allowed to continue the ride. If not, you're thrown off the train, and someone else takes your seat. That's the way it's always been, and that's the way it will always be. Doesn't that ring true with what you've lived through in your own trades? You have to train yourself to welcome reactions instead of fearing them. When a stock you hold dips modestly in a strong move, instead of panicking, you should smile. That's the market cleaning house, shaking out the weak hands, preparing for the next leg up. As long as the tape still shows strength, as long as the character of the move remains intact, that dip is your ally. It's not your enemy. The enemy is your own impatience. The enemy is that voice in your head that wants certainty when certainty doesn't exist. So I say it again, market reactions are tests designed to shake you out. They're not mistakes. They're not flaws. They're the very mechanism by which the market ensures that only the disciplined, only the patient, only the ones who can endure uncertainty reap the rewards of the big moves. And every time you give in to fear, every time you let a small reaction drive you out, you're failing the test. You're handing your profits to the trader who sat still while you jumped. And once you understand that, once you see reactions for what they are, you'll begin to treat them differently. Instead of running, you'll learn to watch, to wait, to sit through them with calm determination. Discipline is holding when emotions scream to sell. You can write that on a piece of paper, hang it on the wall, and stare at it every morning before you sit down to trade, because it's the heart of speculation. Any man can buy a stock when the story looks good. Any man can cheer when it ticks upward. But when the market hesitates, when it dips, when the crowd starts whispering bad news and the papers are shouting panic, that's when you discover what you're really made of. Do you have discipline? Or do you have nerves made of glass? That's the question every trader must answer, and the market asks it of you again and again. Have you felt the tightening in your chest when the stock you own starts wobbling? Have you ever given up your seat too soon because you couldn't stand the noise in your own head? You see, the market is not a game of intellect alone. If it were, the cleverest men in the world would be the richest, but they're not. It's a game of temperament. It's a game of control. Discipline is what allows a trader to act like a professional when the amateurs are being tossed around like corks on the sea. Without it, you're finished before you begin. The tape might tell you everything you need to know, but if your mind betrays you at the first sign of trouble, you'll never profit from that knowledge. Doesn't it strike you that most traders know exactly what they should do, but fail because they can't bring themselves to do it? I've seen it countless times. A man will take a fine position, the market will favor him, but the first little setback rattles him. He panics, he sells. Then the market resumes its climb, and he curses himself. Next time, he promises he'll hold. But when the same test comes, he fails again. Over and over. He doesn't lose because he's wrong in judgment. He loses because he's wrong in discipline. And the saddest part is, he never sees that. He keeps searching for better tips, better charts, better news, when the real fault lies in his own lack of control. Tell me, isn't that exactly what happens with most traders you know? When I talk about discipline, I don't mean stubbornness. Don't confuse the two. Stubbornness is holding on when the market has proven you wrong. Discipline is holding on when the market has proven you right, but your own fear is trying to throw you off. That's the great divide. Any fool can refuse to admit a mistake. That's pride, and it ruins more men than poverty ever did. But real discipline is something else. It's the courage to sit still when sitting still is the hardest thing in the world. To hear your emotions shouting, "Get out!" and to calmly say, no, the tape says otherwise. Can you do that? Have you ever tried? There were times in my career when I knew the only enemy left was myself. The tape was clear. The stock was strong. Everything pointed upward. And yet I wanted to quit. My nerves begged for relief. I remember pacing the floor, biting my lip, looking at the ticker and thinking, just sell and be done with it. Pocket the gain. But something deeper in me would whisper back, not yet. Not until the market itself tells you the move is over. That inner voice was discipline. If I'd ignored it, I'd have thrown away fortunes. Do you see how that difference makes or breaks a speculator? The emotions never go away. Don't think that after enough years in the market, you'll stop feeling fear or greed. You won't. I didn't, and I lived my whole life in speculation. Every trade carried the same weight, the same doubts, the same temptation to act rashly. The difference was that over time I learned to expect those feelings and not obey them. Discipline isn't the absence of emotion, it's the mastery of emotion. It's knowing your nerves will scream, but refusing to let them dictate your actions. Haven't you noticed that the hardest decisions often turn out to be the most profitable? That's discipline at work. The public always loses because the public always follows its emotions. The crowd buys because it feels safe. The crowd sells because it feels scared, and so the crowd never catches the big move. By the time they feel safe buying, the advance is nearly over. By the time they feel scared enough to sell, the decline is nearly done. If you want to rise above the crowd, you must do the opposite. You must hold when fear tells you to sell. You must sell when greed tells you to buy more at the top. That takes discipline of the highest order. Do you think you can muster it? Or are you still swayed by every headline, every tick, every rumor on the street? There was a stock once that I held through the wildest swings I'd ever seen. One day it rose, the next it dropped, and then it rose again, sharper than before. The newspapers were full of talk, each day a new story to explain the move. I had friends calling me a fool for staying in. But the tape told me the trend was intact, so I held. My emotions hated it every night I went to bed convinced I was risking ruin. But my discipline kept me in line, and in the end, that position paid me more than a dozen little scalpings ever could. If I had listened to my feelings, I'd have sold out long before the real profit came. Haven't you had trades like that, where your best gain came only because you ignored your fear? But here's the danger: discipline doesn't just mean holding winners. It also means cutting losers. And that's where most people falter. They cling to losers out of hope and cut winners out of fear. That's the exact opposite of discipline. True discipline says, I will hold my position as long as the market proves me right. But the moment it proves me wrong, I will get out without hesitation. That's the razor's edge you walk in speculation. Discipline holds you to the plan, even when every emotion in your body wants to do the opposite. How many traders do you know who can really do that? It's not natural. The human mind isn't built for it. Our instincts are wired for survival, not speculation. Survival tells you to avoid pain, to seek certainty, to flee danger at the first sign. But the market doesn't reward survival instincts, it punishes them. In the market, the right action often feels like the wrong one. That's why discipline must replace instinct. It's not enough to know the rule. You must drill it into yourself until it becomes stronger than your fear. Can you imagine how much money you'd have saved if you had cut your losers without hesitation? Can you imagine how much more you'd have made if you'd held your winners despite your nerves? I'll tell you, there were times I looked in the mirror and said to myself, you're not fighting the market, you're fighting yourself. That's the essence of speculation. The market doesn't care about you. It doesn't know your name. It doesn't care if you make or lose a fortune. The battle is inside your own skull. Discipline is the weapon that keeps you steady. Without it, every dip looks like the end. Every rally looks like the top, and you'll be tossed around like the rest of the herd. Do you want to be like the herd, or do you want to be the one who profits from their weakness? So when I say discipline is holding when emotions scream to sell, I mean exactly that. Your emotions will scream, they always do. They'll scream in fear, in greed, in doubt. They'll tell you to quit too soon, to cling too long, to jump in at the wrong time. And unless you've trained yourself to listen to the market instead of your nerves, you'll fall for it. You'll trade like the public, and you'll lose like the public. But if you can master yourself, if you can hold steady when your whole body tells you to flee, then you've earned the right to catch the big moves. That's what separates the men who make millions from the ones who spend their lives chasing tips and blaming luck. Rule No.1 is not about entries, it's about endurance. Most people will never understand that, and that's why most people will never make real money in speculation. They think the game is all about the buy. They're obsessed with catching the bottom tick, getting in at the cheapest price, bragging about how sharp their entry was. But the truth, as I learned it, is that entries are the least of it. You can be clumsy with your entry and still make a fortune if you've got the endurance to ride the move once it begins. And you can be perfect with your entry, buying at the exact right moment, and still end up broke if you haven't got the endurance to sit through the swings. Haven't you noticed that for yourself that the market punishes impatience more than bad timing? A speculator's job isn't to buy at the bottom and sell at the top. That's a child's dream. Nobody does it except liars. The job is to catch the bulk of the move, and that bulk doesn't reveal itself in the first hour or the first day. It takes time. It takes strength of nerve. That's why endurance is the real rule, the true number one. Because the market will test you. It will shake you. It will grind on your patience until you want to throw in the towel. And unless you've built the endurance to outlast those tests, you'll always cut yourself short. Doesn't it strike you as strange that the same people who spend all day perfecting their entries can't last a week in a trade before nerves push them out? I used to be just like that. In the bucket shops, I thought my whole skill was in timing my entry off the tape. I prided myself on reading the next tick. I could get in ahead of a little swing and take a profit fast. But those were small plays, little nibbles. The real money didn't come until I learned to endure. When I graduated to trading in the big markets, I discovered that the tape could still tell me when to get in, but it was useless if I didn't have the nerve to stay in. I'd enter perfectly. I'd be right, but I'd snatch at a small gain, and the stock would run 10 times further without me. It wasn't my entry that failed, it was my lack of endurance. Hasn't that been your story too? Think about it this way, the market isn't a sprint, it's a marathon. A sprinter burns out in seconds. He looks quick, he looks sharp, but the race is over before it's begun. A marathon runner has endurance, and he wins by keeping his pace steady while others drop out. In speculation, every man is tempted to be the sprinter. They want quick profits, fast action, excitement. But the ones who make fortunes are the marathoners, the ones who can endure the length of the move without losing their head. Which kind are you? Do you rush in and out, or can you stay the course when the course stretches longer than you expected? Endurance means more than sitting in a chair while your stock climbs. It means sitting while it wobbles, while it tests you, while every fiber in your body says, enough! Because big moves never go straight up. They swing, they retrace, they pause. And every pause is a temptation to quit. That's where most traders fail. They think endurance is only needed when things go wrong. No, it's most needed when things are going right, but slower than you'd like. The itch to act is strongest when patience is most required. Don't you find it hardest to do nothing when the market gives you every excuse to meddle? There was a time I bought a stock just as it broke out. The move was right, the market was behind it, everything lined up. But after a week, it hadn't done much. It moved up a little, then back down, then up again. Any ordinary trader would have closed it out, said it was dead money, gone looking for action elsewhere. But I held, because the tape told me the story wasn't finished. Weeks later, the real move began, and it didn't stop. That trade paid me more than all the quick ones I could have made in the meantime. Endurance won the day. If I'd judged it by the first week, I'd have called it a failure. Doesn't that remind you of times you quit too soon and missed the real payoff? Another thing about endurance, people forget it's a test of character. not just time. Endurance doesn't mean holding blindly. It means holding intelligently, holding when the market is proving you right, even if it hasn't yet given you all the profit you expected. That takes character, because the crowd will try to pull you out. Friends will warn you. Papers will print stories. Rumors will fly. All of them will feed your emotions, trying to break your endurance. The speculator who lacks character will fold under that pressure. The one with endurance will ignore the noise and stick to the truth of the tape. Do you have the backbone for that kind of pressure, or do you find yourself swayed by every voice around you? The market is a great psychologist. It knows endurance is rare, and it exploits that weakness. It gives you little rewards for quitting early small profits that feel safe. It dangles relief in front of you, tempting you to close the trade just to ease your nerves. But those crumbs come at the cost of the feast. You can't have both. Either you endure and take the big move when it comes, or you quit and live on scraps. Which will you choose? I'll tell you, this endurance is the hardest rule to live by. It sounds simple, but it runs against human nature. People want certainty, and endurance offers none.